Welcome back. So I guess all roads lead to Tesla, right? We're gonna talk about the company today, and we have chatted about it before, but I wanted to dig a little bit deeper today and discuss the financials as well as uh, bring you some interesting information about the margins of the company and how you should be treating it in terms of what the company is making financially. And you will see that Tesla has been massively underperforming the last month and the last 3 months, I guess, while it's down 20% year to date, so in 2022. So, Tesla is an interesting case because the stock market has been greeting it with massive uptrends over here. And you'll see that it has been going up and up for the most part with some slow and minor downtrends, really. And this could end up being one of those. But as value investors and hopefully cautious investors, we want to examine whether it makes sense to add a company to a portfolio because when you're buying a stock, you are basically buying a company. And this is how you should be looking at it. You're paying money to buy a company that's going to bring this money back to you, intrinsically at least. And so we will examine Tesla and see whether it's actually worth our buck. And so here we can see in the shares outstanding, first things first, just see whether there is dilution happening. And it's something that you would expect because when the company stock price is that high, the board actually decides to print more stock because it's free. They can print as much as they like. They can keep diluting investors forever if they want to. And so they have basically doubled the amount of outstanding shares in about 7 years or so, which is terrible because if you were holding, let's say, 1% of the company in 2013, if you haven't bought any stock since then, now you're holding 0.5% of that company because there is double the amount of stocks being traded in the open market. And so this is how you should be looking at it, and this is what it actually is in terms of economics. This is how it works. Now you may be saying to yourself, yeah, but the company stock price has been going up. The thing is that the fact that the stock price has been going up has nothing to do with the fact that you are now less of a shareholder. Because the stock market is like a voter's game. It's like what people decide. It's what the public decides that the stock is worth today. It's not what the stock makes financially, and it's not how much you own of the company. The thing is, over the years, in a long period of time, these things tend to rationalize. And so, if valuation is very very high and is not rational based on what the company is making, then you are maybe in for a surprise in the years to come. Now you never know. I mean, the company could still be the trendy thing and keep on going up. But as a value investor, you want to at least know what you're getting into if you decide to buy Tesla. So let's take a little bit of a closer look here. And the first thing that we're gonna do, and I wanted to take a look at before we do our usual analysis, is take a look at the profitability of Tesla. I wanted to show you something. So we have talked about margins in this channel, and I have made a full playlist about these topics, and I'm adding the description in the video below, in which I'm explaining the video that I'm explaining what margins are. In this case, let's take a look at the net income margin. What is that? So again, you can watch the video, but quickly so that you can understand. Net income is what the company makes after all the expenses are taken off its revenue, plus taxes are also accounted for. So basically, it's what the company makes bottom line in the bottom line, the amount of money that stays with the company. And in here, it's 7% currently in the last 12 months. So 7% for every $100 in sales, that Tesla makes, they get to keep 7.4 of those dollars in the very end, after all expenses are accounted for. And so let's take a look at a different company now. Let's take a look at Apple, for example. And we're gonna go to Apple's profitability tab and take a look at the same thing, the net income. Let me find it here, net income margin. So the net income margin of Apple is 26%, is massively higher, is like what, 4 times higher, almost. So why is that? The thing is, Tesla is a car company, and people would say to you that it's a tech company. It's not. It's selling cars, and it's making the margin of what cars are selling, at least currently. I don't know what's going to happen in the future. But the reason why Apple has that high of a margin, and I'm pretty sure Google may even be higher than that, is that they're selling a lot of software. And so software doesn't cost anything in terms of making. I mean, you make it once and then you sell it forever. But cars, they have a lot of upfront cost to make for each one of those. So let's go back. This is a very, very simple way to actually determine what kind of company you are looking at, practically speaking, in terms of margins, because a car company has this kind of margins, and even lower actually. 7% is actually pretty good, because you can see companies like, and actually let me take a look. Let's take a look at Ford here, Ford Motor Company, and you will see here in the profitability tab that the net income, let me find it here, the net income margin of the company, I can't find it. So the net income margin of the company is 2% for Ford, but for Tesla it was 7. At least it's a little bit better, but nowhere near a company like Apple, for example, or what Google would be. So let's take a look at the income now of the company. The good thing about Tesla is that it at least growing its revenue, so it's selling cars. So the revenue is a measure of how much you can sell, really. That's what it is. How much what is the amount of things that you can sell and how much money you can make out of those things that you can sell. But it's not what you get to keep. And so in the very end, what you get to keep is the net income. It's over here. And literally, Tesla was literally losing money for many years, and now it's making some net income, which is nice to see, obviously, because you do want these companies to eventually make some net income. That's the whole point. And in terms of the balance sheet of the company, it's growing its assets. The equity is growing here, which is nice to see. And the cash flow, which is at the very end the most important thing, you will see here that from operations they are making money as expected. And cash from investing, they are also investing in capital expenditure. Interesting thing to take a look at the cash from financing here and look at these lines, for instance, issuance of common stock. And again here, they keep on issuing stock. And this is part of the reason why they have so many assets, really. And I talked about it earlier. They keep diluting investors. That's a horrible thing for you, the investor. And also getting debt, because they keep on getting debt too. So there's a lot of plus here, which is not a good thing, because it means more debt or more selling of shares, really. So free cash flow. Free cash flow was negative here, but now it's growing positive. It's at about 2.5 billion. And if you say that's 2.5 billion a year, the company's market cap is 800 billion. That's an insane multiple. Like if you multiply 2.5 in order to get to 800, you need to multiply it with what, like 300 or something of that sort. It's absolutely insane. So probably a little bit more, 350 or something. So the multiple, the current free cash flow multiple to the market cap is absolutely insane. It's very high, and that points to a very overvalued company. And again, I'm not saying that the company is not great, because I love the cars, but as an investor, you want to take a look at whether it makes sense to add it in your portfolio, because it's making money and it can bring you this kind of cash flow again intrinsically with the company's growth. And do you want to pay $1 for today and get it back in 10 years? I mean, that doesn't really make sense. And I'm talking in terms of free cash flow, which is important. And so you will see here that the debt to equity ratio is low, as you would expect from, if they're selling all that stock, they definitely have a lot of stock, a lot of assets. So this is why I wanted to make this video, basically, so that I can explain to you that these kinds of companies like Tesla can have like these deep valuations and very insane, actually overpriced valuations, and people keep buying them just because they are trendy. But at some point, when the stock market goes down, they can fall massively, and this could even be the start of a downfall at some point, because it really matters how much you are making in the very end. And regardless of how much you are growing, this whole overpriced thing won't be going on forever. And as long as Tesla can support it, maybe it can keep going for a little while. But when something is massively overpriced, it's the first thing that's gonna fall when the market goes astray. And if there is a downturn in the economy, one of the first things that people won't buy is electric cars. So you have to factor all these things and speak to yourself and be like, okay, do I want to invest in something that's that overvalued today just because I think it will keep being overvalued and more overvalued in the next few years? This is what's going on. This is the current picture with Tesla. And again, if you actually understand all this and you are fine with risking some money in order to get a return out of an overvalued stock that's pricing in hype, really, then more power to you. I mean, you may enjoy some gains out of the blue, but if you're a value investor and you're looking at this from a free cash flow perspective and a growth perspective and what you are paying today and in order to make in the next 10 years, you just can't be investing here. So this is why I made this new sort of video with the idea to explain to you what's going on with Tesla and how you should be treating it and what you should be thinking about it. So let me know what you think about it. Are you still buying it? Are you still a buyer of Tesla? Are you selling it? I'd love to know. And if you did enjoy this video, you may watch this one that I made about Alibaba, which I think is a much more fair value when you compare it to a company like Tesla right now. So thanks for watching, and I'll see you in the next video. Bye bye.